This is total growth investing, where price growth is not enough, dividend growth is not enough. We want to identify stocks, funds, and other investments that perform well in both of these measurements, because when we find them and buy them, we can beat the market over the long term. Brick and mortar retail stores have taken a hit over the last 20 years with the rise of the internet. Especially over the last 2 years with the global pandemic and the current global supply chain issues throwing monkey wrenches into all attempts to keep those stores going strong. People are still loyal customers of Nordstrom's, Dick's, Boot Barn, and Dillard's, but when almost everything they sell is available with just a few clicks of a mouse and free shipping, what we are seeing is a change of the retail market the likes of which we have never seen before. What will it take for them to survive? And more importantly for us, what will it take for these stores, these companies, to actually thrive as we move towards a new retail world? The number 2 stock on my total growth investing ranked watch list right now is Dillard's. Let's dig into why it is ranked that high and whether it is a good investment starting in early 2022. Dillard's Incorporated was founded in 1938 by William T. Dillard. He was born in Arkansas and worked in his father's general store and Sears before getting an associate's degree in business administration from the University of Arkansas and a master's in business administration from Columbia University. He opened his first store in 1938 in Nashville, Arkansas, and got a head start thanks to working with the wholesalers and credit offerings who had long dealings with his father. He expanded the company by opening stores in Texas and across the southern U.S., including the first Dillard's in a mall in Austin, Texas in 1964. Their initial public offering was on May 9, 1969, and the stock started paying a dividend in 1992. He was an early adopter of computerized checkouts and inventory systems, and by the end of the 20th century, the company was the 3rd largest department store chain in the country. The accounting department at the Sam M. Walton College of Business at the University of Arkansas was named the William Dillard Department of Accounting in 2020. Dillard's is a family-run business, with his eldest son, William T. Dillard II, taking over as CEO in 1998. His brothers, sisters, and his son Bill III are on the board of directors and the executive team. In 2012, 4 of the 5 top executives in Arkansas were from the Dillard's executive team. The CEO, William Dillard II, was first. His brother and the firm's president, Alex Dillard, was second. Their brother and executive vice president, Michael Dillard, was fourth. And their sister and executive vice president, Drew Matheny, was fifth. Third on the list in 2012 was Michael Duke, the CEO of Walmart. At the time I'm recording this on January 15th, the stock price is at $250.28. This is a solid stock price after a good run in 2020 and 2021. The sudden rise up to 400 might have been a short squeeze, but the stock price landed on its feet and has stayed around 250 for the last few months. The question we need to ask is whether the success that the company has seen is going to continue into the future. Dillard's is a household name in the southern states of the U.S., with 282 stores. Their concentration in the South and Southeast might give them a lot of potential for expansion opportunities, but they've also been reducing the number of stores they have over the last decade or two. One of the things that sets Dillard's apart from their competition is their tendency to actually own the stores they operate, as opposed to leasing or renting. 246 out of the 282 locations they operate are owned by the company. That's 43.6 million square feet of sales space out of a total of 48 million completely under their control. Compare that to Macy's from their 2020 annual report, where out of 789 locations of Macy's, Bloomingdale's, and Bluemercury, they only owned 328 of them. Here's a chart of the top 4 department stores showing their answer to the age-old question, to lease or to own. I found a new data resource, companiesmarketcap.com. Here's their charts for Dillard's under market capitalization, revenue, and earnings. Retail volatility, especially over the last few years, makes these charts hard to look at if we want to try to make predictions for the future. So let's take a look at 20 years of data from their annual reports and see what direction things are going. This is net sales in blue and net income or loss in red. The trend line for raw dollars is going down, but also consider the reduction in the number of stores over that same period. On the same timeline, this is earnings per share. You can see the 2008 crisis and the 2020 pandemic, but overall it looks like the last 20 years have been good for them, and for us as shareholders. When I add in the trend line, you can see that even clearer. That trend line is going in the same direction when we look at dividends. The first thing we need to do is ignore the special dividends that they paid in 2021 and 2012. Those skew the numbers a lot. But if we just bring up the regular dividend history, we can still see a dramatic increase over the last decade. That's where the dividend growth numbers come from that I use on the TGI data entry sheet. Special dividends are a nice bonus, but we can't use them to project the future. The growth numbers from regular dividends are high enough to beat all but one other security on my list when the ranking scores are averaged out. And the returns, price returns, are spectacular thanks to that massive run since the bottom of the pandemic crash. I am seeing some analysts being pessimistic on whether Dillard's will be able to maintain their profitability when the supply chain disruptions are brought under control and people start actually shopping again. Motley Fool is an example, with this article that came out on November 16th after the third quarter report came out, with some spectacular numbers and prices started going up very quickly. You can see the price was $341 when the article was published, and it spiked up to $400.16 before the end of November. One of the authors you can find on Seeking Alpha saw the same numbers and is more optimistic about their ability to maintain costs and inventory under control. Dwight thinks that the special dividend caught the attention of retail investors, which is why we saw that massive spike before the price fell back down again. I agree with him. Dividends are a big draw right now. Look at this channel. Whether Dillard's is going to keep surprising the analysts, only time will tell. I'd like to look at Portfolio Visualizer though and show you what our return would have been if we'd bought the stock early, 20 years ago, 30 years ago. Portfolio Visualizer has data going back to 1994 for both the S&P, SPY, and DDS. So let's run a comparison. The first one goes back as far as we can. The second one starts in 2002. Backtests like this really depend on where you started on the timeline. There is one other thing that I want to show you, because there's one other stock in Dillard's portfolio, DDT. In 1998, Dillard's bought and merged with Mercantile Stores Company Incorporated. This was a company founded in 1914 after the collapse of yet another dry good retailer, H.B. Clarifin Company. Mercantile had survived the World War I era, survived the Great Depression, transformed itself into a fashion retailer by the end of the 1930s, and took advantage of women joining the workforce and having increased spending power during and after World War II. It started expanding and buying other companies, focusing more on suburban customers. The baby boom of the late 40s and 50s allowed them to tap into home furnishings and appliances. The history is the classic American business story of the 20th century, and in classic American fashion, they were bought out by Dillard's just before the end of the century. This was the biggest department store acquisition since the 1994 Federated takeover of Macy's, and this was also the last action taken by William T. Dillard before he handed control of the company over to his son, William II. I love history, and I also enjoy it when stock research like this spins off the research part into history like this. But let's get back to the meat of things. DDT is a company that was set up by Dillard's to raise the capital needed to complete the merger with Mercantile. The Capital Trust owns all of the subordinated debt from raising $200 million towards the full amount needed to complete the acquisition. There is a link to the original prospectus in my Rizzoma notes. What's important for this presentation is the dividend history, which is rock solid, and the price history, which is also steady going back 5 years and before. This was a 40-year trust and expires in August of 2038. In all likelihood, that dividend will stay constant until that point. So, what do you think? Tell me in the comments. I could talk a lot more about the history that I've read about Dillard's, Mercantile, H.B. Claflin, etc., but I couldn't find many images to go along with it, so it would probably be boring reading. Check my Rizzoma notes if you're interested in following up more on that. I will show this, however. If we add DDT alongside DDS in Portfolio Visualizer, with the same portfolio going back as far as the site has data, the compound annual growth rate of that 50-50 split portfolio is 12.34% over the last 24 years. And if we check what our income on that investment would be, it's pretty nice. What if exploration can be fun? We just need to make wise choices going forward. Thanks for watching. As always, if you liked this video, please hit the like button and subscribe to the channel. I will continue down the TGI ranking list, keeping the data updated, and we'll see what stock comes up for review. Right now, the next one is an ETF focused on U.S. home construction, ITB. Along with this YouTube channel, please also like the Facebook page. And if you'd like to talk about the TGI ranking system and the stocks at the top, please feel free to join the Facebook group. I do these videos for fun, not profit. The profit comes from making good choices in investing and watching the returns. Let's beat the market.